We're looking at profit and loss accounts now, or sometimes called income statements. They're actually, the modern name for them is income statements, but some textbooks are a bit behind with the times, so they still call them profit and loss. So I'm going to call them profit and loss accounts because that's what's written in your AQA textbook. So there's lots of specification objectives here that you need to know about. Now I've actually just broadened it out a little bit to give you a bit more detail. So one of the specification objectives says that you need to identify the components of a profit and loss account and balance sheet. We're not going to do balance sheets in this presentation, I'll do it in the next presentation. But here are some of the terms that you should know about. So revenue, cost of sales, gross profit, expenses, net profit. We've got to calculate those, gross profit and net profit at least, and we've got to be able to use profitability ratios. So this is gross profit margin and net profit margin, to be able to interpret whether the business is performing well or not. So let's just jump into this. So just a bit of background for you. Each company is required by law to keep accurate financial records, and there are three main records that they need to keep. Cash flow statements. Now, luckily for you, this is in Unit 1, so you don't need to know this necessarily for Unit 2. The information is useful for Unit 2 to have in the back of your mind, but you won't be asked questions on cash flow in this exam. But in Unit 2, we need to know about profit and loss accounts. And this is going to show basically whether the business is making profit or a loss, but it breaks things down as well. It's going to show how much revenue they've made, how much money they've made, they've brought into the business from selling their goods and services, the costs of making those goods and services, the gross profit, the expenses or overheads. Sorry, it's just split on there, hasn't it? So it looks, it's meant to say overheads, and then the net profit. And we'll have a look at the difference between gross profit and net profit in a few slides time. And the balance sheet, which I'm going to do in a separate presentation. This shows what the business owns, its assets, what it owes, its liabilities, and what has been invested into that business, so the capital and the reserves. So here is a simplified profit and loss account. If you look up an actual business's profit and loss account or income statement, there would be many more items on it, but for GCSE's business studies, they make it nice and simple for you. So a few things just to be aware of. The most recent year, I know it seems a bit weird because we do write from left to right, but when we come to accounting, the most recent year always goes on the kind of the inside column, so that this column here was the most recent year, and it's next to these items, the titles of the items here. So sometimes some students get a little bit confused by that, but don't let that catch you out in the exam. So sales revenue. Now, you're going to come across this as well. Unfortunately, in accounting, we have many different names for the same thing. So I'm not saying divide turnover by revenue, because they're actually the same thing. I'm saying turnover, also known as revenue. And we know from Unit 1 that that's just the quantity or the amount of sales times the price of those sales. Now, this is the new thing that you'll be learning, costs of sales. These are what we call the direct costs. These are the costs of making those goods and services, the materials used and the labour as well that has got into making those goods and services. Now, there will be other costs, but those will be costs to the business, to run a business, you know, your utility bills, the marketing bills, the accounting bills, and those types of things. When we're looking at costs of sales, we're only looking at direct costs, the actual physical costs of making that product. Okay, so all you need to do to work out cost of sales is, all I've done there, I've got your answers there, is I've just added up those two numbers, the cost of materials used and the cost of labour used there. And I've added them up and I get 320,000 in 2014, and it was 205,000 in 2013. Okay, gross profit, our first type of profit that we're coming across. Now, this is just sales revenue minus those direct costs, so the costs of sales. So when we work that out, we're going to see that it is just, I'll get a pen, it's going to be our sales revenue minus our costs of sales. So that's going to come out as that. 180,000 in 2014, but it was much more in 2013. Overheads, another one that's a bit confusing, is sometimes called expenses. So I apologize for that. It's not me that's coming up with all these confusing terms though. This is just the accounting world. There always seems to be two different names for each item, and you just have to remember it. These are all the indirect costs, overheads or expenses. So these are the costs of running the business, but they're not necessarily the costs of making the product itself, but they are important costs because they're the costs of running the business. So the last thing to work out is net profit. Now there's two ways you can work out this. So if you worked out gross profit, all you need to do is minus your overheads or expenses. Or if you haven't worked out gross profit, you need to start with the revenue minus the cost of sales and then minus the overheads as well. So we're going to get these numbers. Now, I just want to point out some really interesting things about these accounts here. So we know that this was the furthest away year, and this is the most recent year. As I've said before, it always goes in this column here. But if you look at these revenue figures, it looks like, if you weren't looking at profit, it looks like this business 2014 than they were in 2013, because either they must have sold more items, or, this isn't a brilliant pen, I'm going to change my colour. So either they've sold more, so the quantity's increased, or they've been able to price, or a bit of a mix of the two. So it looks like they're performing really well, but actually when we work our way down the account, we see that things aren't as great as they seem, because actually cost of sales have increased. Now we would expect cost of sales to increase because these are direct costs. So if you sell more, it's obviously going to cost you more to make more because you're making more items. So we would expect that to happen. That's not so much of a problem. But it is really disappointing because your cost of sales have actually increased at a faster rate than your revenues increased. Yes, revenues increased by £100,000, but look, your cost of sales have increased by more than £100,000, which means that your gross profit is actually reduced from 2013. Overheads have increased as well. Now, there's a bit of disagreement in the accounting world, but if you're making more, you would expect your overheads to increase a little bit more. They're not direct costs, but maybe if you're launching new products, there's more marketing spend and those types of things. But it has reduced your overall net profit as well. So not only the cost of sales going up have reduced that net profit, but the overheads increasing by £20,000 have decreased that net profit. Okay, so not only would you have to interpret the accounts, but you have to work out the profitability ratios. So profitability ratios are really useful because they allow us to compare one year with another year, or two separate companies of different sizes. Because the problem with just analysing this data as it is that they're actually making different amounts of money in each year. So what we use is these profitability ratios. The first one is gross profit margin that we can look at, and this shows the percentage of each pound sold that is gross profit. So for every pound that you get in revenue, what percentage of that pound is gross profits? And this is the equation. Sometimes you can do most students put gross profit by revenue times by 100. They don't necessarily do the times by 100 part on the top, but I've just written it like that because it was easier for me on the computer. But the important thing to remember with this one is you don't need to memorize it for the exam, because you will be given it in the exam. However, you might have to work out profit, so just be aware of that one. So for 2014, I've just taken the gross profit, 180,000 there, divided it by 500, and I've got a percentage of 36%. So that means for every £1 sold, 36% of that is gross profit, or 36p is gross profit. So it doesn't sound so bad, does it? However, when we compare it to 2013, which is just 5,000 divided by £400 worth of revenue, we find that the gross profit margin was 48.75%. So that meant for every £1 spent or earned in revenue, they had roughly 49p's worth of gross profit. So actually our gross profit margin has decreased. So it's not looking so good there either. The other profitability ratio that we can use is net profit margin. So this shows the percentage of each pound sold that's net profit. Now net profit is the one that usually we're a lot more interested in, because that's the profit at the end. You do have to deduct tax from, businesses do, but that's the profit that the business has left to distribute in dividends to shareholders or maybe reinvest into the business. So the equation for this is net profit divided by revenue times by 100. We're just timesing by 100 to get it on. We see it when in with the gross profit margin as well. We're only timesing by 100 just to turn it into a percentage, really, to make it easy to understand. So in 2014, it was 60,000 divided by 500,000, which came out as 12%. So for every pound sold, they had 12p of gross profit. So sorry, net profit. Made a mistake there. So that doesn't sound so great, does it? You know, doing all that work and then only getting 12p's profit. And then in 2013, if we compare it to 2013, we get 95,000 divided by 400,000, which means that it was 23.75%. So in 2013, for every pound sold, they had roughly 24 pence worth of net profit. So 2013 definitely was a bit of a better year for this business. So that's usually about a 2-mark question that you have to work out. Just be aware, sometimes they are going to give you the equation, but again, with net profit ratio, similar to the gross profit ratio, they might not give you the net profit. They might want you to work that one out. So usually after a question like that, they're going to ask you to interpret it, and my students are all really good at doing this because they know, first of all, they need to tell the examiner whether the gross profit margin or net profit margin, whichever one you're looking at, has got better or it's got worse. So they always make a statement, gross profit margin has improved or net profit margin has deteriorated, meaning got worse. Now remember that businesses want their margin to be as big as possible, to be as high as possible. So if it's decreased, it means it's got worse. And then sometimes, it depends on the question, but sometimes they want you to explain why it could have got worse. So there's only really 2 reasons. With gross profit margin, we're only considering the costs of sales. We don't look at expenses or overheads. So if gross profit margin has deteriorated, if it's got worse, it means that your costs of sales have increased at a faster rate than your revenue has increased. And we certainly saw that in that last example. Net profit margin is a little bit more complicated because it could be that sales have increased at a faster rate than revenue, as we saw in the last one. It could also be overheads because we take these into account when we get net profit. So if the overheads have increased at a faster rate than revenue as well, that could decrease net profit margin. Although in the last question, our overheads had increased, they'd only increased by 20,000, which is quite a big increase on the 100,000 that it had been in 2013, because it is 20%, but actually revenue had increased by a faster rate. Revenue had increased by 25% because it had gone from 400 to 500. So in that case, it was actually that the cost of sales had increased by a faster rate that was really causing the net profit margin to decrease. The other part of the question, they may ask you, not always, but they may ask you ways of making it better. So I'm going to use a little diagram here. You wouldn't need to draw this in your exam, but it can really help explain what's going on with our gross profit margin and net profit margin. So remember, revenue, and I'm using this square to represent revenue, and revenue is just that price times the quantity, the amount that you've sold. And if we imagine this area represents the amount of money you're making, okay? So if you minus out your cost of sales, so your cost of sales will take up an amount of that money. If you minus that out, what you've got left, this blue box here, becomes your gross, not brilliant colour there again, your gross profits. Gross profit. So whatever's left of that blue box there is your gross profit. If you minus out again your overheads, you find that you have that blue section there is your net profit that's left. Okay, so if we're thinking about improving our gross profit margin and our net profit margin, what we either need to do is grow that blue box or shrink these boxes here. So what we could do is we could increase the price, but That might mean that fewer customers buy the product. We could lower the cost of sales, but it might mean that the quality suffers, possibly, or we could reduce overheads such as marketing, but that might mean cutting promotion.